Shares of Tesla giving some back today after a big boost yesterday on a very bullish note from Morgan Stanley's Adam Jonas. RBC also staying positive, writing in a note today that Tesla should be able to capitalize on IRA tax credits more than any other automaker. Shares are down nearly 2% this afternoon. But Needham says not so fast. They're seeing some profit margin pressures ahead and say fully self-driving cars are still a ways off. The firm lowered their 2025 Tesla earnings estimates to 15% below consensus. And joining me now, the analyst behind the note, Chris Pierce. He covers EV names at Needham. Chris, welcome to the program.
Thanks for having me.
Would you describe yourself, just to set the scene here, as a Tesla bear, or is this more of a tactical call?
I would say more tactical than not. I do think Tesla deserves a premium multiple. I think Tesla is going to sell a lot of EVs in the next few years and beyond, but I just struggle to, given the price cuts we're seeing, the price cuts in FSD for the first time. I just looked at consensus estimates for margin improvement in 24 and, looking at raw material inputs, looking at the potential for future price cuts, looking at legacy mass market operating margins. I just struggle to see those Tesla being able to meet those expectations.
Yeah, I mean, I look at what's coming out of China, and I would be really worried if they do to EVs what they did to other consumer products. There could be a lot more downside ahead, couldn't there?
Yeah, I think we're already seeing that at the high end. I mean, Tesla's cut prices for the Model S and Model X, by a decent amount this year. I did some channel checks at local Mercedes-Benz dealerships. I live in Northern California. We're already seeing, at the high end, Mercedes dealerships in Northern California, over 50% of their deliveries this summer have been EVs. And we're seeing similar stats in similar direction in Southern California. So, what's going to happen as we see competition at the mid and lower end? We're going to see Tesla potentially have to take further price cuts to stay competitive and to keep these factories humming and get cars on the road. So I just struggle to see margins moving back at the pace that consensus expects them to, especially next year.
Yeah, the headline of your note is lower for longer, which all of our viewers will appreciate, is a little bit of a nod to what we've been saying opposite about the Fed. So I don't know if you gave Adam's note a read yesterday on Dojo. Just kind of put that in context. As you say, they just cut the price of full self-driving. So, how big a market and an opportunity do you think they really have?
I didn't read the note. I think we're actually making similar calls. He's saying not to put words in his mouth, but he's saying there is this out-year goodness around what can happen if they put all these pieces together. We don't have a lot of proof points that they can put those pieces together. That feeds into why they would cut the price of full self-driving. They need to get more vehicles on the road with this package so they can do more video learning to kind of, as a strategy shift from a code-based program to kind of a video capture program. So they need to cut the price of full self-driving to get more cars on the road to gather more data. But he's saying this goodness might not be recognized in the stock in the longer term. I'm saying this bumpiness in the short term is not being recognized in the stock versus, what might happen if you look at consensus estimates. So, he's just taking a longer term view and saying people aren't focusing on X. That may happen, but on the road to X, people aren't focusing on Y. I should have reversed those letters since Y comes before X in the alphabet, but the road to get there is going to be choppier than I think most people expect.
Is it V? What comes before X? Okay.
I should have just said A.
They're telling me I gotta go. Chris, thank you very much for joining us today. It's a great note. I encourage everyone to read it. We appreciate your time. Chris Pierce.